Would it shock you if I told you that the bank wants to make money? Of course not. Now, let's talk about today. About the topic today is how the bank wants you to pay your loan off, and what to do about that instead. So the bank and you, they lend you a dollar, but I mean, how much do you really pay them? And most people think that they know what they're paying for when they get a loan, but even though they know, they don't know. And what I mean by that is that, yeah, most of us know that we get a loan and there's, interest that's being paid to the bank, but and we know they make some money, but we most of us don't really know how much that is. And it doesn't really surprise you if I told you that they want to squeeze as many dollars from you as possible, right? So how much do I pay the bank anyways? Look, and here, just so you can check this out, in a typical loan of $350,000 at 6% fixed for 30 years, you're gonna be paying, if you pay the way the bank wants you to pay, $405,000 over that, or 405 in interest payments alone, in interest money alone. So this is how the bank sets it up for you. They'll divide your payment between interest, the profit, and the principal. Now you'd think that they'll do, set it even, right? So every payment's the same amount of interest and the same amount of principal. But you know what? The bank wants to win at this game, and they're very good at winning. And they set it up in a way that you will pay their profit way before you pay off your loan. And here's here's like an amortization schedule on a payment for this loan for 350, and you start off, let's say you start off with month one, your payment's 2129. Well, 1776 of that goes to the interest. That's the bank's profit, and only 353 goes to your principal. And every month it goes, interest rate goes down and your principal goes up. You see how the next month you paid, I don't know, almost $2 worth more of principal, and so forth. It keeps on going, keeps up little by little until eventually, you pay off your loan. So if you pay it the way the bank wants you to pay it, it's going to take you 23 years to pay off half of your loan balance. So you know what? The game is, don't pay it the way the bank wants you to pay it. And there are ways to pay it, and some, without even actually spending an extra dime, that will save you some serious cash. And we're going to take a look at those. And of course, I'm sure there's 1,000 different ways to do it, but I'm going to talk about 3 specific ones today. And certainly you could pay more to the balance of the loan every month. If you pay, in this example, if you pay $100 extra per month to the principal, well, you pay off your loan 3 years and 5 months early. So 26 years or so, and you're gonna save yourself quite a bit of change there, 54,000, almost 55. And that's a lot of money. But let's talk about my favorite, which is the biweekly. Now, no, guys, it's not the biweekly method. The bank offers you a program where you make a payment every 2 weeks, because at the end you're still paying it the way they want you. And believe me, you're still paying a lot of interest on that. But I'm not going to go into how much that is in today's seminar. But let's go through how you're actually going to pay it off. So look, on the 15th of the month, before the payment is due. So let's say your payment is due for January 1st. On the 15th of December, you're going to pay half of the principal required per your amortization schedule. Okay, and now think about what I showed you earlier today. So on the 1st of the month, you send the rest of the payment. So for example, on the 15th of the month, as per the amortization schedule that we're looking at, you're going to send only $176.83, which is half of the 353 and 66 that was from the principal that was being paid off. The rest of the payment, the 1953, is sent on the 1st of the month. So if you add both of these up, the payment ends up being still 21, 29, and 91 cents. So you're not sending a penny more. However, by doing that, the loan gets paid off 5 years and 6 months early. And the interest savings on that is $86,841. The reason that happens, guys, is that the bank cannot charge you interest on what you already paid. So if you pay your principal on the 15th, that's 15 days early, well, they can't charge your principal, they can't charge your interest and not on the 1st, right? That's how that gets done. So you pay that off without spending an extra cent more. All right, that's great, right? I know the first time I heard this, it blew my mind. And there's also double principal, which is just send twice the principal required per the amortization schedule. and the loan gets paid off in 15 years and 1 month, which is an interest savings of over $200,000. So recommendations: take action today, apply one of these strategies, and pay off your loan faster. Don't let the bank take your money. You spend the money the way you think you should spend it. Take action also and invest in your first home if you haven't bought one, or invest in or your investment properties. If you haven't bought one, or if you bought some and you stopped, now is the time to get started again on that. And guys, I am here to help. I am here to help. Thank you very much for seeing this seminar today. Again, my name is Paul Anthony Kelly from themortgagespin.com. Feel free to click on the links below to get started with your property search, or if you need to sell your property, click on the appropriate link there, and we'll get you guys started. Thanks a lot, and we'll talk to you next